Thank you so much for being here with us. I'm Eliza Rohde. I'm the Managing Director of the Sorensen Impact Foundation. Really excited to have this group here today. We're going to be talking about social acquisition funds and the incredible impact opportunity that these strategies present in the market right now. I think social acquisition funds remain a little bit under the radar in the impact space, but I think hearing from these experts and these incredible practitioners in the space will help you, like I have recently come to appreciate, that it's time for more attention on these strategies and these models. I think many of us are aware of the phenomenon of the Silver Tsunami, the unprecedented increase in the aging population in this country. And a very substantial piece of that phenomenon is the fact that we have over half of the small businesses in this country are owned by owners who are over the age of 55. The reality is that presents a huge opportunity right now for impact-oriented acquirers to transform the DNA of the small business landscape and help really usher in a new era of regeneratively minded companies, which is what everyone up here is really sort of oriented towards and focused on. The last thing I'll say before I jump into intros is I think many of us in impact are very drawn to sort of big, innovative ideas. And yet it's conversations that I've been able to have with these panelists that remind me that our pursuit of big and flashy sometimes blinds us from opportunities that might be right sort of in our backyard and can still deliver transformative impact. So I think the panelists here will help show us why social acquisition funds fall in this category, why the demographic reality we have today with the Silver Tsunami presents a tremendous opportunity for these strategies if we can rally the capital to fund them. So to dive into the topic, I'm really excited to introduce our three panelists. They're building models that are quite unique from each other, and I think we'll be able to create a really interesting picture of what's going on in this space. So right on my left, Allegra Stena is the co-founder of New Majority Capital, a firm that's in the search fund model of funds. They're focused on closing the persistent wealth gap in the US by increasing the number of underrepresented business owners through an entrepreneurship through acquisition strategy. The fund leverages unique structures to provide investor returns while offering non-extractive capital for underrepresented entrepreneurs to acquire businesses. Allegra sits on the firm's investment committee and manages external partnerships, and before founding New Majority, she worked at JP Morgan in investment and commercial banking. Carla Leon, we're skipping over one, we'll be back, don't worry, is the president and CEO of Just Like Family Home Care, a social enterprise that provides home care services across Canada. Carla led the first social acquisition of an entity by charities in Canada, transforming Just Like Family Home Care into a social enterprise with the profits of the enterprise supporting charities. And we're going to go deeper on that model shortly. Throughout her career, Carla has also provided coaching to thousands of entrepreneurs. And last but not least, Cordell is the GP and CEO of Regenerative Capital Group, a Canadian impact PE fund investing in entrepreneurs to acquire established SME businesses and involve value creation strategies towards becoming regenerative for society, environment, and economy. Cordell is a past impact fund manager, executive in clean tech and circular economy businesses, and worked in international development in Watsan market systems creation. And with that, we'll dive in. So our three panelists are working in this space with very different strategies and approaches. And before we get into more specific questions, I want to take a few minutes for each of them to really, in their own words, tell you about what they do, how and where they deploy capital, and sort of the impact thesis that drives their work. Cordell, I'm going to start with you because you helped bring this panel together. I'm asking you to do a little bit more work to get us started. Could you give a brief overview of the activity in this space, this social acquisition space? What are you seeing? What is sort of the different strategies that are rising to the top? And then a little bit more on what you do with Regenerative Capital Group.
Thank you, Liza, and thank you everyone for being here. Just before we get started, can we just get a gauge in the audience? How many of you, by show of hands, are working in social impact acquisitions currently? Okay, just a few hands here. This is great. As Eliza said, this is a very overlooked aspect of our impact world. We are all here at SOCAP trying to take on some pretty big issues in our time here. The polycrisis, all these nested, interdependent issues that all revolve around our economic system and how we've set them up. And it can be a lot, taking on small parts and smaller outcomes of this big nefarious system. And, how do you tackle a pulley crisis? The excitement here for all of us on the panel is with a tsunami, with the Silver Tsunami, with this opportunity of the largest component of our economy, the small, medium enterprise economy, the biggest part of our GDP. And we're speaking here as Canadians. It's the same in the US. It's the same across the developed world in looking at what is, I think, the most overlooked area of impact. If we think of a bell curve, we focus a lot of our efforts on each end, the small ends of the bell curve. So really startups, innovation, clean tech, and a very important part of the future that we want to have here. But also inherently the riskiest component of what we can invest in. And then we can look to the other side of the bell curve, which is really the larger corporations and organizations later in their life cycle. And we know we can move a lot of capital there institutionally, but we also know these are the biggest organizations that are most allergic to transformative change, that have the hardest time changing their spots in terms of what's made them successful. And so what's really exciting here is the opportunity and this inflection point that's provided by this next decade ahead. In Canada, I'll speak to these statistics, and again, it's 10x here in the US, but we have about 1 million small, medium enterprise businesses that are changing hands. 91% of these baby boomers ready to retire do not have a succession plan, meaning they don't have a child or an heir apparent in the business who can afford to acquire that business. That's a real crisis. That's our Main Street economy. That's where all of the hearts and minds and the vast majority of people are employed. And we do not want to see these businesses shuttered and sold for assets. And the other options have been, seeing them sold to private equity, to strategics, which for the most part have been somewhat degenerative to our economic and social systems going forward. And so what's presented here is really the opportunity to evolve our Main Street economy, to really look at regenerative economics, to evolve value creation strategies. And so how do we do that? Well, we've got this incredible thing that's been developed here, and which Allegra is going to speak more to in a few minutes, which is the Ivy League business schools here in the US have set up this incredible investment vehicle known as search funds, investing in younger entrepreneurs to go in, buy these types of businesses, and with investment capital and ecosystems of support, grow these businesses forward. It's been an incredible 35-year history of this asset class. It's outperformed private equity and venture capital 2x. And I won't steal any thunder here and let you explain the model a bit more here. But this is entrepreneurship through acquisition, and this investment vehicle has proven itself as an incredible vehicle to steward the legacy of our Main Street economy forward. And so quickly, what we're about, Regenerative Capital Group is really using this search fund model, investing in next generation entrepreneurs to go in, search for and acquire these businesses, look to owners who are values aligned, who want to see their legacy stewarded forward, not just for squeezing of cash flows and higher multiples and a lot of their staff and social capital pushed to the side, but ultimately how their legacy can go forward, yes, as an exit strategy and the highest multiple they can get, but also in addressing some of these wider systemic challenges that they see going forward. And so we at Regenerative Capital Group, we invest in cohorts of entrepreneurs. They buy these businesses. We buy out these businesses as a fund, and then we incentivize them through vesting equity to, yes, grow these businesses in tandem, meeting environmental, social, regenerative performance targets that we don't prescribe, but we go in with them and with their stakeholder ecosystems that they are inheriting to determine how do these good businesses, ultimately knowing that business as usual is the riskiest thing we can do going forward, how do they evolve their value creation strategies, and how are these ecosystems going to co-determine what the higher purpose of these organizations ultimately will be, and how they will become the 21st century companies that we need. I'll leave it there.
Super, thanks for that. Allegra, I'm going to turn to you. You are also, with New Majority Capital, also deploying a search fund model. So talk to me a little bit about how that shows up for you all within Majority Capital and what your overarching goals are.
Sure. I'm glad to be here, everyone. And before I start, I'm curious to know how many folks in the room have invested in a startup or in venture funds, personally or professionally? Okay, that's good to know. Wouldn't it be nice to invest in an asset class where there's cash flow on day one? Right, just let's sit with that thought for a second. And so that's kind of piggybacking off of what Cordell mentioned. So at New Majority Capital, we're an impact fund manager that's focused on helping underrepresented entrepreneurs acquire and scale existing small businesses. And so to touch on the history of ETA, the traditional model of entrepreneurship through acquisition, or search funds as it's called, is where typically a post-MBA or current MBA student at a top 10 MBA a top 10 business school in the United States would go out and find investors to fund a 2-year search period. And so that, they'll raise, call it $300,000, $400,000, $500,000 to fund their salary, diligence costs, et cetera, to find a business. Once they find this business, those same investors have the first right of refusal to invest in the deal. What the economics turns out to be at the end of the day is where the investors own about 75% of the company to 80%, and the entrepreneur 20 to 25%. And that's a traditional model. The self-funded model, which is what we exclusively focus on, is where the entrepreneur themselves has majority ownership, if not 100% ownership of the business. It's leveraging debt, typically an SBA 7A loan, which is a government-backed product that allows for these acquisitions. And so what we're focused on is the fact that in the United States, we have 12 million businesses that will be available for sale. Every single day, 10,000 baby boomers are retiring. And so this is a unique opportunity. It's what the asset managers are calling the greatest transfer of wealth in our lifetime. And we want to ensure that individuals who historically have been strategically disinvested have an opportunity to participate in this economy, in this ability to generate, to build generational wealth. So that's what we focus on. We have an accelerator called Beta that trains entrepreneurs on acquiring businesses. It's a 10-week hybrid program, currently backed by JP Morgan, and that's run through our nonprofit. And then after the accelerator, we also have a fund that our entrepreneurs are able to tap into to get gap equity or partial equity for their acquisitions. Typically, these acquisitions, from our perspective, are in the $500,000 to $2 million EBITDA space. So our portfolio, we have 193 alumni from our accelerator, 16 acquisitions, 20 currently under LOI, and our portfolio ranges from anywhere from on the low end, a couple $100,000 to $27 million in purchase price of these businesses. So that's what we're focused on. Our number one benchmark is the wealth that is being generated by our entrepreneurs. We're tracking that from day one to 5 years post-acquisition. We want to make sure that our entrepreneurs are not just buying a job, but they're buying a business that will lead to wealth creation for themselves, their families, and also their employees. Because a mandate of our fund is that 10% of the cash flow distributions on an annual basis as a minimum must be returned to the employees of the business so that they're benefiting in the real-time upside of the company. So that's what we're focused on, and I'm glad to be here.
Thank you. Carla, I'd love for you to speak a bit more in detail about your model as a social purpose holding company, and specifically how it's controlled by charity investors, as I understand it. This was a new model for me, so maybe a new model for some in the room as well. I liked a lot of the framing you provided about, and we've spoken about this a little bit, about creating real tangible impact by focusing on acquisitions that are not yet on the radar of traditional PE firms, and also through your model, creating a diversified investment opportunity for charitable investors. So with that minimal framing, could you elaborate a bit more on your model and impact thesis? And I'm particularly curious to understand sort of what the capital raising process looks like for you, and how that journey has been.
Okay, great. So mine is completely different, and it's not as scalable, I think, as both of these models are, which is super exciting. However, what I'm going to describe to you is something that any charity, any person could actually do themselves. So this is kind of if you wanted to own it yourself. And so my thesis was that charities should actually start buying businesses. So if you think about a diversified portfolio, you're probably going to have your bonds, your stocks, your mutual funds, and if you're actually an accredited investor, you're going to actually do some direct equity investments yourself. But charities don't do that. The neat thing is that charities are actually accredited investors once they have, in Canada, over $150,000 to invest. And the reason that is, and Allegra is going to give you the US in just a second, but the reason that is because they have trusts, they have the boards, they have an investment committee. So the fiduciary duty and duty of care that they have in terms of the due diligence to do the investments is in place at a much lower threshold than an individual accredited investor would be. So an individual in Canada has to have $1 million of assets to invest outside of their house, but a charity, with all the extra due diligence structure that they have, is only at 150. Allegra?
Yeah, that's when Carla mentioned that to me, I was shocked because in the United States, it's $200,000 minimum for the past 2 years in income, and then $1 million in net worth, excluding your primary residence. So this model that she's mentioning with regards to charities stepping into the space is actually quite unique and could be catalytic.
Absolutely. So you think about it, all of a sudden we have a whole new realm of accredited investors that we're not even speaking to when we see these opportunities, and specifically in social acquisitions. And the best thing about a social acquisition is that you don't have to do the same type of due diligence. Oh, wow, a business has been operating in my community for 25 to 30 years. I know them, I've been working with them, maybe I'm going to that place regularly every single week. That's my due diligence. Right? I look at their EBITDA and I go, oh, I can do that. So what we ended up doing was creating a social purpose holding company. It's like any holding company, but our focus was being over 50% with accredited investors that are charities. And that's how we did the fundraise. So at this point, we set up our holding company, we had the shareholders buy into that, and then we purchased our first business. And 4 months later, we were able to purchase our second business. And as you keep on building these businesses that have a positive cash flow that Allegra was talking about, well, guess what? You're building a balance sheet that you can keep on buying more. So to me, it's actually an imperative that accredited investors as charities are thinking about direct equity investment, because as you're hearing, some of the multiples are much higher than you're going to get from a normal investment portfolio. Many of our accredited investors as charities, they're going to like a bond, or they're doing, in Canada, we have a GIC, which is only delivering you 5%, 4% on a regular basis, depending on how long you're invested. Well, all of a sudden, we're looking at 20%, 30% with many of our funds here. So why private equity? Like, how do we scoop under? I always look to what private equity firms are doing and then just see how we can take advantage of our social capital to do better. So a private equity firm is looking at usually a 2 million EBITDA to acquire. Well, with all the charities and all the social capital that we have here, I'm getting businesses shown to me at $500,000 up to 1.5, that my multiple to buy them is at 3 to 4 instead of 5 to 6 or even 10 to 12. So I'm scooping in with my social capital before a private equity firm can. So yeah, we can do better.
Great. I love it. Cordell, you spoke when we had our sort of pre-conversations about, and you mentioned this a little bit in your intro, but aligning value creation strategies with ecological principles. And I was just hoping you could go a little bit deeper in terms of how that framing informs your work and shows up in the deals you do.
Yeah, thank you. So I think we're all here understanding that we have some big work in figuring out how to align our economies with our ecologies here. And I think there might be a question here. We've just heard that these groups are all buying cash flow positive companies from day one, tried, tested, proven businesses that have inherently already proven that they're providing value to people and to economy here. And so we might say, how do mom and pop businesses, which traditionally haven't taken an impact lens, start to do that? And the types of businesses, I'm sure this is the same at New Majority Capital, the types of businesses we're looking at are very unsexy, as opposed to clean tech and high innovation and impact start strategies. These, again, are the mom and pop businesses that put the pipes behind the stage here. These are the businesses that are the HVACs and the plumbing and really the heart of our economy. And by having been focused on bottom line capitalism, on bottom line viability, that's been wonderful for our economy, but ultimately that's also left a lot of value creation opportunities on the table. And so by widening the lens, to include some of the environmental, social, community factors and ecological factors. I think as many people in this room have been proving with their efforts, it's not that question of trade-off any longer of impact or market rate returns, but ultimately a greater abundance that we're all looking for here. So when we talk about regeneration, and we know this word is catching a lot of, there's a big zeitgeist moment around regeneration. How do we get past sustainability? And maybe somewhat controversially in this room, sustainability is a bullshit idea. Sustainability, there's no such thing as sustainability or steady state anywhere in nature. And so this idea of let's just put back what we take, well, first of all, we're too far underwater to deal with that. We're not trying to sustain degrading biospheres, widespread mental health crisis, greater inequality, you name it, any of these polar crisis issues. So let's get beyond that, and how does regeneration and how do we ultimately look at leaving more than we were left with become a guiding ethos of value creation strategies. Many who are working in regeneration are looking at regenerative agriculture. And that's come out of the permaculture movement and other. How do we make things very abundant here? When we look at regeneration, we're ultimately taking a very different approach to impact than we traditionally have as impact investors in this space. At the core of many of our theses and investment strategies is a theory of change. And that theory of change and those log frames of inputs, outputs, outcomes, that's done well for us. And look, we're moving what did Jin say, $1.5 trillion in the impact investing economy last week, the announcement. That's been a good stepping stone. But ultimately, there's an inherent flaw in taking that theory of change and log frame, and that's been that Einstein quote, you can't solve the problems with the same mind that created them. It's a very industrial and somewhat colonial approach to impact. How do we, with the money or those in control, ultimately push down outcomes onto those organizations and ecosystems that work with this? In regeneration, and I'll speak for Regenerative Capital Group, we're investing in people first and foremost. I hope that's not mine in the bag there. We're investing in people to go out and buy companies. And many of these individuals are going out to buy SMEs where they have a history of experience. If I've been in manufacturing distribution, I might look for a manufacturing and distribution business, but I'm sure it's the same for New Majority Capital. Many folks go out and buy a business outside of their field of domain. A good business is referred to them, or a broker leaves them a good business. And so one, we don't know the types of businesses we're going to be buying going in. And so it's very difficult to say, well, what's your fund play? Is it a decarbonization? Is it a circular play? We don't know. And so ultimately, we go in, we acquire companies, and then we work with those entrepreneurs who are taking leadership roles in this inflection point. And really understand that this inflection point is not just a change of ownership. This is an entire new chapter for the business. They go in and speak with these stakeholder ecosystems to co-determine what the opportunity is for this business. We may look at a business and say there's clearly a decarbonization or circular play here, but when you speak with the stakeholder ecosystem, they actually raise up a social impact play that is far more important. And what's important is not to say, well, we've bought this business and there's an impact component that you now need to include in all of the work that you're doing, but catalyzing the system to work together and start to address these needs. And this type of systemic approach, we heard from Dominic Hofstetter at TransCap yesterday. There's a lot of movements going into looking at not just segmented reductionist, mechanist ideas of little pieces of impact that we can play, but how do we catalyze these systems so that ultimately they're supporting thriving, yes, economic, environmental, and social, cultural aspects of the communities based on place, where they are, people, how they work together, and then ultimately a renewed purpose. How do we take these good vehicles and the cash flow that is starting from day one and use that to fuel the transition that we want to see?
Thank you. Allegra, was going to follow up with you sort of in this vein on the work that you do to identify and train entrepreneurs to be ready for this undertaking that they're taking on. What does that training look like, and how much of it is incorporating some of these regenerative mindsets that Cordell alludes to, or are there other things that you're really emphasizing in the training and work you do with your entrepreneurs to prepare them for this journey?
Yeah, and so I think we touched on this before, but this concept of entrepreneurship through acquisition, it isn't mainstream. It's not taught. Just to give context, during my business school experience for 2 years, I was heavily involved in entrepreneurship in the Entrepreneurship Center on campus, and I didn't even hear about ETA until my last semester of business school when we co-founded NMC. And so our focus is on taking this business school concept and removing the gates, right? It's been gate kept for decades now, and so making it available to a wider swath of society. And so in our accelerator, we designed it assuming that individuals are not familiar with this concept, and so starting from bare bones, what is ETA, right? How do you craft an investment thesis? How do I even find a deal? And so it's a 10-week accelerator. The first half is focused on buying the business, so finding the business, doing valuation, structuring the deal, et cetera. The last half is focused on running the business. How do you do HR and technology and ops and scale and transition the business successfully with the current owner? These are some of the things that we're talking about and making sure our entrepreneurs are aware of. How do you establish broker relationships? Something that we find that's interesting, and I was sharing this with someone yesterday, is that a big part of this is psychological, outside of it being a transaction. And we talk to brokers and they say, these MBAs, they always, want to put everything in a model. You can't, there's certain things you just can't factor into your Excel model, right? And so just to give you an example of that, we had a Stanford engineer in our DC accelerator that happened this spring. And he had a realization as he's, going through this deal, and he's just like, I realize I'm actually going to have to manage people when I buy this business, right? Imagine Stanford engineers worked in corporate his entire career, and now he wants to buy a blue-collar business where perhaps his employees definitely didn't go to Stanford and they don't have this background, and how is he going to get them to respect him? How is he going to build trust with this population that may view him as an adversary? And so it's as much of a psychological process as it is a financial undertaking. And so those are some of the things that we're teaching our entrepreneurs. We've brought in therapists for our entrepreneurs in certain cases to make sure that they're stepping into, for some of them, wealth that they perhaps couldn't even dream of on day one. We actually track that. We track from day one our entrepreneurs, what is their current household income? Are they the child of or are they themselves formerly incarcerated? Are they an immigrant or not? Like, we're tracking all these things. Do they own or rent? Because we want to understand what is the situation that they're walking into. And we want to also make sure, as I always say, that the words on our website align with the lived reality of our entrepreneurs. And so that's what we're focused on.
Yeah, love that. I realized I forgot to say at the beginning, folks, you have some cards on your table. If you have questions for our panelists, please fill out those cards and just raise your hand. And our awesome helper over there, Eliza, we share a name too, which is pretty fun. We'll come and collect the cards from you. So just fill those out and raise your hand as you have them, and we'll get to questions in just a little bit. Great. One thing I want to talk a little bit about with all of you, so this is open floor here. One of the things I have observed as an investor looking at some of these fund opportunities is, the pace of transactions it's not fast, and for a lot of good reasons. But I'm curious to understand your perception of this pacing and how we might accelerate the pace of transactional activity in this space in particular. Are there legislative tools or legislation in place or in process that you're aware of that would be really sort of transformational for creating incentives in this space? Anything like that?
I can jump in here. This is one of my frustrations, is the pace of the acquisition. So to give context, when you're doing an SBA 7(a) transaction, it typically, from the day you sign the LOI, the letter of intent, to the day you close on the business, can be anywhere from 90 to 180 days. So that's a long time to buy a $2 million, $3 million business. There are cases where you can buy a $100 million real estate building in 7 days. So that was a question I posed to the team, and I'm like, why can you buy, I can buy a very large real estate deal. I can get that deal done in a week, in 2 weeks, but it's taking me months and months and months to close on a business. The diligence process is long, and trying to figure out how to put things into play to, I think AI is hopefully going to help speed up diligence and so forth. Granted, the diligence is worth it, right? Because you need to make sure that this business, the cash flow that's on the paper is actually in the bank account. Like, you need to make sure that this is happening. However, there's so much bottlenecks in the system, and we're trying to speed that up, implementing things to ensure that our entrepreneurs are able to move through the process. We have 23 capital partners, and we actually have weekly meetings with several of them to make sure that our entrepreneurs' deals are getting through the pipeline, because otherwise it just stays stuck in an underwriter's inbox, and we're trying to move that faster. I think the SBA earlier this year, they made some rule changes which allowed for more of these acquisitions to take place. They allowed for partial acquisitions, so that's great, where an entrepreneur doesn't have to buy 100% of the business, and that's actually advantageous in many cases where the seller wants to stay on and perhaps is a large government contract that they've been working on, and they deserve to get a piece of that, and so they want to stay on, and also helping for the transition, right, to make sure that these businesses transition well, that the incoming owner has a good process in place to understanding the key customers and building relationships with the employees and so forth. So I do think those rule changes have helped, but there's lots more that can be done to speed up the process. Something else is that you can't use SBA funds for like employee ownership. That's something that I know some friends here are considering and working towards. So there's lots of different opportunities. But I think the number one thing is that we need to have more folks that, like you all in the audience, aware of ETA, investing in these sorts of acquisitions so that we can move all of our collective missions forward. Prior to getting here at SOCAP, I was listening to some sessions on YouTube. And I'm like, 15 years ago, we were talking about some of the same issues. At this convening, it's like, why haven't we moved forward? And so hopefully those of us here on stage, but also you all as well, can participate in transforming this in our lifetime. As I always say, this can happen in our lifetimes.
Yes, it is. I'm going to give the opposite of like how slow it was, or how many barriers I had to do this acquisition, and why we need these funds. So when we purchased this, we had. Basically, we are a franchise network, so we're a franchisor. But the way that we found this deal is that an individual church bought the Just Like Family Home Care franchise in Victoria, BC. They grew the business from $250,000 to $1.7 million in 3 years, owned by a church, which is an accredited investor, just so you guys know. And so when they did that, the founder of Just Like Family Home Care went to the church and said, I need a succession plan. I'm tired. Would you buy this thing? Social acquisition. So the church came back to me. I was the head of innovation with the United Church of Canada at the time, and they said, can we do this? I reached out to 187 charities, signed the LOI on January 21st, spoke to 187 charities, did the due diligence. Actually, the person who supported me on due diligence is in this room. Thank you, MJ. And I had 3 charities who said yes, and in 82 days, we waived all conditions and moved forward with the purchase. Now, in mergers and acquisitions, what I did, I found out later, was impossible. But I never knew it was impossible to actually close a deal in that time. We also had to raise debt. No financial institution is going to work with me as a startup in less than 90 days. I actually had to get private lenders in order to ensure that the charities owned more than 50%. So all of that, all the mechanics, setting up all of those pieces is not scalable, although it was exciting and fun. But having organizations like these two with their funds, now I can present a new opportunity to either of them where it is that we can actually have that scale.
Just add one more thing to this, which is the pace of deal flow is tremendous. Here in the US, 10 million businesses changing hands in the next 10 years here. Deal flow has not been an issue. There are a lot of good cash flow positive businesses here, but really in transforming business as usual practices. A lot of our deals are debt-laden deals. We buy good businesses. The incumbent banks are happy to lend 50% to see their customers going forward. They know they're good businesses, and so it's no problem. We usually do seller's notes as well, 25%, and so we can leverage these deals and our equity quite tremendously. The challenge here is that, well, first of all, impact investors are starting to understand, wow, 35% historical IRR in this asset class. We don't usually get these types of PE opportunities for impact plays. So that's wonderful for our portfolios. But when we start to look at blended finance, as I know many of you in here are, there's more we can do. When these entrepreneurs buy these small, medium enterprises, they're faced with the same challenges that any small, medium enterprise entrepreneur needs to deal with, and that's, cash flow. They're dealing with paying off debt and trying to grow the business. And there's really a lot more that we can do in the impact sector here. If we have 30% style returns from equity side of things, what does that mean that we can do on the debt side of things? How can we provide lower cost of capital, favorable terms, patience, so that these entrepreneurs aren't driven to the shortest term thinking in their decision making? How can we give them, yes, great business proven platforms to go out and make this transformative change, and also give them more breathing room so they can think longer term, so they can start to make regenerative decisions throughout. So I think there's a lot we can do with the different tools that we have in this room and at this conference.
Great. So I'm going to go in a direction to ask for some help from all of you. I'm an impact investor with a venture capital background, and I think everyone in this room probably would admit and acknowledge that venture capital is a really powerful tool for some things and absolutely the wrong tool for many other things. I'm very curious about alternative structures that can be deployed with impact capital. But I admit that I'm sort of coming up a learning curve in this space. The Sorensen Impact Foundation is very interested in the ownership economy, and so I've been looking at a number of employee ownership funds and other sort of pass to home ownership funds, et cetera. I think in this space in particular around ownership through acquisition, employee ownership, I'm still grappling with how to determine which models are going to be replicable, scalable, and sort of differentiating between the slight nuances I'm seeing. So I'm wondering if you all can help me and maybe some others in the room who are really aligned philosophically with what you're doing, but are potentially coming from sort of different asset class backgrounds. Like how do we get smart here? How do we understand what's happening and how to sort of distinguish the models that are emerging in this space?
So I think when you buy a business, you understand what you think the impact's going to be, but once you get into the rabbit hole, it's much, much deeper, which is why I love thinking about, so my example, when we bought this business, which is home care, we knew that we could improve the quality of life for seniors aging in place, and we could do that better. What we didn't recognize is the dramatic impact on our caregivers and how we've changed their lives as well. Just by treating them with dignity and respect and having the values alignment and then having living wages, rolling out health spending accounts because we're owned by charities. So the ripple effects are much deeper. In addition to that, we're also a franchisor. So just like McDonald's head office and all the restaurants, we're like that. So when we bought this with charitable dollars, it was all about who owns things matters. So when we sell franchises, we have a specific focus on recruiting more BIPOC owners and having more charities and nonprofits own franchises at the local level. In the last 2 years, by being intentional of who owns things and that mattering, we bought it at 26% of our franchisees were owned by BIPOC individuals. In 2 years, we're over 50%. So when you're intentional about it, it's very, very easy to do the right thing.
Yeah, I'd just say that for those on this learning curve, again, we kind of take a look at, we just had a large investor come into the fund, and having a very emergent impact strategy. Many investors have their favorite flavors of where they're looking at impact, and this is quite open, this is quite emergent. We're not sure until we get the place-based nature, the people-based essence, and the renewed purpose of these organizations. And I said to this investor, why did you come in? It was a large check size, you don't know what you're getting into. We're going to be on an emergent learning journey together. Why did you do it? And he said, quite honestly, because the business model is so sound behind this. Like, we're not concerned about our return on investment here. We're excited by what could be exponential impact here, and that impact exposure risk that we're taking with you, we're willing to go on that journey. I spent a number of years bringing human-centered design concepts and development approaches to the international development context, and it was very similar. The first funders would say, why would we invest $500,000 or $1 million into this developmental process? How many toilets or water filters or smallholder farmers are we going to have by the end of year one? And I'd say 0. I'd say, how many would we get by the end of year 2, year 3? And I go, I have no idea. I'll tell you what incrementalism looks like. You give me an extra $1 million, we'll probably get this many more smallholder farmers or toilets or water filters out there, and multiply that out. Are you willing to go into a developmental process to have potentially catalytic exponential impact here? And this is somewhat similar. The business models are very sound here. Now, how can we use these platforms to evolve our economy?
Great, thank you. I'm gonna weave in some of the great questions we've gotten from the audience. I think tying to the last question that I raised, one of our audience members asked just a little bit of a description of what the fundraising process has looked like for you all with these somewhat novel models and models that are less familiar to some in this space.
Sure, I can jump in. I'd say the fundraising process is a grind. That's the word I use to describe it if anytime someone asks me. Ironically, so we have a 501c3 and a fund. Ironically, it's been, I'd probably say, 10 times easier to raise philanthropic capital in our foundation than it has been to raise capital for the fund. To give context, as I mentioned before, JP Morgan is one of our largest partners, and I counted, it was like one or two meetings before they said yes. And it was just like, that's like unheard of. And the reason I'm calling that out is because we need more of that. That's like unheard of. I think there was a VC on LinkedIn that counted and said it was like 83 meetings they had before they got a yes. That's insane. And so I see Michelle here. We've been working on moving things forward, and SOCAP, actually, a shameless plug, right after this, we're having a GP-LP matchmaking session. It's the first time it's ever happened at SOCAP. It is to allow this place to not only be a place for conversation, but also for capital. I've gone to so many conferences this year, and I'm like, I tell my team I'm done with the chit chat, right? Because we've talked and talked and talked, and we're not actually solving problems by just talking. And so, yeah, the fundraising process for us was a grind. However, we have found a lot of catalytic investors. So, for example, Skoll Foundation is invested in our fund, and we actually had an event, and Marla mentioned that, the president, she mentioned that, she went to Stanford, so they teach ETA. It's like the landmark place for ETA, and so that's how she was able to come on board, because she knew the asset class, she knew what her classmates had done and how they had succeeded. So he's like, oh yeah, we definitely need this for with an impact lens on top. And so I definitely say there needs to be more focus on it. From a learning curve perspective, there's lots of different resources that are free out there. Most of the top business schools have ETA conferences, so that's a low-lift way of just getting in the room, understanding what are some of the transactions that are moving, who are the players, what do the returns look like, what does the diligence process look like. We have our accelerator, as I mentioned, and we actually allow for prospective LPs and grant makers to sit in and just see what it's like to be in the class. It's been eye-opening for some of our grant makers and our LPs to just like, oh wow, they're learning. And some of them will tell us like, hey, actually, can I join the cohort? Like they're like, can I be a part of this? And so, yeah, this concept of search funds, it's transformational. I always mention that a lot of the companies we know and love started this way, even though we may not know it. Starbucks, it was a small business that someone bought. Delta Airlines, same thing. Chobani Yogurt, ABC News. These are all large companies that scaled through buying small businesses. And so this is not a new concept. The concept and the chatter around it may be new, but this has been happening secretly in back rooms for decades.
So I would say mine's a little bit, it was very, very difficult at the beginning because it was the first time that we had a coalition of charities buy a business. So people are like, what? So it took a lot of relationships, which is really what equity is versus debt to me, has been about the relationships. And remember, I said I spoke to 187 charities and only 3 said yes. So I don't talk about the 184. I speak about the 3 who actually were brave and courageous, and that's what we need more of. I will say now, because I am not a fund, I'm able to talk about specific businesses that I'm looking at. And that gets really exciting and sexy for many of the charities who understand. They go, wait a minute, so this is the programs and this is the impact that I want to make, but you just found a business that is aligned with that, that's going to give me revenue for when people can't afford it. So I'm finding that easier now. And in Canada, I'm really trying to frame that we are the people to go to if you want to do a social acquisition, and we have the holding company to do that. So ours is a little bit easier because it's specific, but that's just like fundraising when you're fundraising for a specific thing. And that's not, I think, really the point. It's working for me, and we're trying to prove that this is possible, but I do believe it's actually the funds and investing in the funds that is really going to be the systemic change we're looking for.
Yeah, maybe just one quick addition and novelty with what we're doing. We're a traditional 2 and 20 GP, LP, private equity style fund. And to allow for the emergent impact strategy, as I've shared here, we've structured the fund from learnings, many of those who have been here at SOCAP, in putting impact-linked carry into the fund. And so with impact-linked carry, if our CEOs and residents and CEOs that buy these SMEs aren't hitting the regenerative performance targets, they're not vesting their equity in their fund. The bonuses of their teams are not being met. We as GPs aren't participating in the profit of the fund. And so there's no possibility for greenwashing or regen washing in our case. And that really puts skin in the game. And that's something that I'm excited to see all of the developments this past year in impact-linked compensation and research and amplification that are out there, but I think really helps in us evolving a business as usual case here. And so that's been helpful in our fundraising abilities.
Great. A question, I think employee ownership is on a lot of people's minds, maybe more so than the entrepreneurship through acquisition strategy. They're very, they blur together in many ways. And as you mentioned, Allegra, you have a requirement of the fund that I think is 10% or so is allocated to employees, if I remember or heard that correctly. So we have a question that's sort of pushing in this direction, asking about, where's the overlap here? And when you think about ownership and the opportunity presented by the Silver Tsunami, how do we make sure that the workers who are powering these businesses are part of the ownership outcome, and think about sort of that more broadly beyond just identifying an entrepreneur. So I think your model specifically is factoring that in. You might want to speak a little bit more to that to clarify for the audience. And yeah, I think the sort of root of the question is, the people who power the business know the business best. Why not identify someone from within that pool to run the business?
Yeah, and to that point there, that's actually a strategy. We've had entrepreneurs in our accelerator who want to buy the company that they're currently working for, and they're working with the current owner to have that smooth transition, so that is an option. Our mandate is that 10% cash flow payment to the employees. There's other mandates out there, the ESOPs, the EOTs. For us, we're focused on a lot of businesses that wouldn't be a suitable fit necessarily for an ESOP. You typically have to have a certain number of employees in the business, has to be structured a certain way, and we're looking at a bit smaller businesses that would fit that structure. And so there's a variety of different options out there. I think we need more in pretty much all of the different directions so that we can ensure that, yes, the employees, I was speaking at a conference earlier last week, and I ran into an entrepreneur. She's selling a pool company. And, she's having some issues selling it. Her and her husband are running it. And I said, do you have management in place? And she said, no, I'm doing the work. And I'm like, well, you can't sell you, right? And so you actually need to get management, and that management is your revenue, right? For lack of a better word, that is how you're generating and building wealth for the company, for yourself. So we definitely need to make sure that as these businesses transition, that the employees that are the backbones of these companies are able to benefit in a tangible way.
Yeah, and it's not mutually exclusive, I agree, right? So for our model, we're investigating at the holdco level having EOT. And then as a franchisor, we're influencing and providing resources for our franchisees to consider ESOPs and EOTs as an exit strategy and to normalize that. And especially within home care, to start a home care co-op from scratch often fails, often very difficult, and it's usually a huge weight on the founding member or the founding members. Whereas if you actually have a home care business at a certain level, so you're 20 employees, now you're at a level that a co-op conversion is actually much more sustainable. So actually the work that we're doing is leading there, but it's not something that we can necessarily do today. It's something that we're actually building, so it's a more sustainable model in the future.
Yeah, and just quickly, here in the US and in the UK, you guys are way ahead of us in the employee ownership trust model development. We just had the legislation put through this spring, and we still only have a two-year window on opening this up. And so we as a fund are looking at really being a catalyst to how do we know that a regenerative economy has to be a more widely distributed ownership economy. That is truly the only way wealth is supported throughout. And so we're looking at how our exits will be to EOT exits. And I'll just add one other piece that kind of builds on the EOT model. I'm not sure if it was this morning or if it's tomorrow morning, but I see Dr. Cowan from Buckminster Fuller Institute here and some of the work that's happening around bioregional finance facilities and the bioregional movements. And so there's some exploration going on as well in what does exits to employee owners look like, but what do exits or percentage of exits to land commons also look like? And who are the types of investors and partners that want to see natural capital actually have ownership stakes in the businesses that operate within the bioregions that they exist in? And so no answers yet, but good questions that I think many of us are on an exploratory journey together with.
Great. Sort of on the owner-employee dynamics, a few of the questions that the audience submitted were curious about navigating that transition period. And you mentioned in particular, a Stanford engineer liked models a lot. People wasn't so sure about that part yet. How do you, or maybe you can, from your experiences, give some examples of how those transitions have played out? And there's a lot of opportunity for friction when you have a new person coming into a business that's been running for a long time. The workers know what they're doing. They have a way of doing it. So can you either speak to some experiences of helping entrepreneurs navigate that transition, building that trust? Any fun war stories?
Sure. For our entrepreneurs, we typically give them a 100-day transition plan. However, with that said, there are things that'll come up that are just not in the plan that we couldn't have thought about, you couldn't diligence out. We try to make sure that our entrepreneurs do as much diligence as possible in advance. So, sometimes sellers won't want to have a prospective buyer meet their employees. However, if you can, that's a great opportunity. We've had an entrepreneur who was able to, essentially go undercover as a prospective client and got to meet employees. Just so you understand what's going on, you need to know prior to buying the business, which employees haven't gotten a raise in a while, and how are you going to address that day one? Are you going to have some retention bonuses, or what are you going to put in place? We've had some business owners, new owners, where they come in, they implement like a workforce development play, and making sure that the employees are trained and are upskilled for different sort of jobs. So there's a lot of different ways to approach a transition. Sometimes that transition looks like where the buyer has a specific plan where the seller is going to stay on for 3 months, 6 months, 9 months, and then transition out. In certain cases, we had one entrepreneur where she became the general manager of the business that she was looking to buy. And so that gave her and the seller an opportunity to kind of test things out and see, hey, do I actually really want to do this? And that's a low risk way of getting into this. So there's lots of different ways of handling the transition. We just want to make sure that the employees and the entrepreneur is able to successfully get into this business and with as little friction and volatility as possible.
So as a franchisor, we have about 5 to 10% of our franchisees transition every year. So I see a lot of this too. And I think what has been really important when you buy something as an operator is understanding that you have to believe that you're the person who actually can, just like any entrepreneurship, you believe that you can do this better than anyone else and that you can add value to this. so we've purchased under the Holdco 3 companies and transitioned them, but I've also seen everyone else. And the interesting thing is the confidence and overcoming your own fear about that is critical, because oftentimes you think it's the other people is what it's reliant on, but as long as you can actually scale yourself up on the learning curve and you can, I would say, even take those deep breaths so that you're not panicking, you're actually going to make it through, especially when you're doing an acquisition that has a certain level of EBITDA. You do have that room to fail and to learn that you are going to come out the other side. On the HR side, the people who thought they were the most important people in the transitions, when it transferred, typically that they weren't as critical to the business as they thought they were. And if you think about it, if you've ever been in a large corporation, they always say, you know, everyone's replaceable. And in a transition, that happens as well. It's just they might think that they're more important to the success. But if you have the bare bones that we're talking about of an acquisition that's been in the community for whatever duration of time, you're actually going to make it through.
Yeah, I completely resonate with both of those comments and both your comments. And so I think 2 pieces. One, we always do every deal with a large seller's note or a vendor take back. And so we want these sellers to be heavily vested in ensuring there's a smooth transition. And yet, at the same time, we want them out of the business as soon as possible. And so although many of them will say, well, I'd like to take a year or even 6 months and still support and consult, if they're really heavy on it, then we'll invite them to stay on. But oftentimes we find that within a month or 2, they're already on to the next chapter of their lives, and they stop showing up on Fridays and then Thursdays and then weekly, and very quickly we're happy to get them out. And quite honestly as well, for the new entrepreneur, it's really hard when people can go around to the old business owner and say, the new guy or the new gal is doing this, and I don't like that. And so that's a piece of it. The other piece I'll say is that really we're in a copacetic relationship when we're in conversation with these business sellers. If they're selling to Regenerative Capital Group, it's because they're also vested in the legacy of stewarding. They're also vested in the narrative of stewarding their legacy forward in a better way than private equity or a strategic or someone else can. And so they really have bought into, yes, they're going into a new chapter, but my life's work is not just going to be more business as usual. It will go on, and my children will see that our legacy will deal with some of these bigger issues that we all know are going on around us.
Great. Got one more late entrant here. Oh, I thought you were giving me a question card. Okay, false alarm. I thought we had something different. We're time warning, which is great because I think we've gotten through a lot of great questions here. One thing that came up, I'm curious about the answer here too, and I think, entrepreneurship is entrepreneurship. It's all in for the entrepreneur. And we had a question from the audience asking about sort of how accessible is this path to women or men who are starting families or are interested in doing that. Is there any, I work with a lot of entrepreneurs trying to balance that. It's just really hard. Is there anything in particular that you would comment on sort of the accessibility of this path to younger adults who might be starting families, and how, if in any ways your models accommodate for that? And maybe, if you have percentages, what do they look like in terms of sort of women versus male entrepreneurs in this space?
Sure. So quickly, we have 193 alumni in our accelerator. I'd say in every cohort, we have about 30 to 40% women representation. For us, that's a win. Obviously, we want to get to parity, but if you look at the search fund space in general, it's about 90% white male, and so we're outperforming from that perspective, still have room to grow. In our accelerators, we designed it assuming that majority of our entrepreneurs are working full-time jobs, and so with that, they also have responsibilities, caring for parents, taking care of children. We call them beta babies. We'll see them on Zoom sometimes. They'll come in with their babies, with their pets. We are open for that, and we also support that. So give you a tangible example of that. We had an entrepreneur in our New York accelerator, and she had some childcare concerns. And so we said, hey, we want you to attend class. Can we give you some funds so that you can actually cover childcare so that you can attend class, right? And that was transformational for her. We actually had another entrepreneur in one of our accelerators that, we flew in her mom to take care of her kids so she could attend class. And so we are trying to make it as accessible as possible. Obviously, we can't do that in every single case, but where we can, we will, to ensure that, we're lowering all the barriers to this opportunity for as many people as possible. So yes, this is something that families can attend. We've actually had, I remember in one of our accelerators, we had a gentleman came to me and said, hey, can my wife sit in on this? Because I think she needs to be bought in on this as well. Like, hey, you're going to quit your job and you're going to buy a business. It's like, if we look at the demographics of the people that we're looking to serve, many of them are risk averse, right? And they have good reason to reject this notion of, hey, I'm just going to be an entrepreneur and everything's going to work out, because they've seen the many cases in their communities where it didn't work out and the startup failed and, we had to foreclose on a house. They've seen those examples. And so we're trying to make it as accessible as possible in both giving them representation and bringing them real life examples of entrepreneurs that have done it, but also helping them relieve the real barriers that exist to getting this acquisition done.
I can give very tactical pieces on it. We find that the first 90 days, you're like 100 hours a week as the operator, like you're all hands on deck. But again, because it's an acquisition, it comes with a team. And really the goal is to structure and to continue to capacity build within your team so that you are resilient as the operator.
Yeah, that's a great distinction. Go ahead.
Just a last piece, as a father of a 5-year-old and 1-year-old, very much appreciate that at the fund level, not the entrepreneur level right now. And I think it's the tension that we all hold regardless of the life situation that we're in, and that we're all trying to address some pretty big issues here as quickly as possible and not fall into an industrialized, mechanistic way. So it's these types of life issues which are the fractal opportunity to actually do business better. So these questions that look outside of the professional landscape are truly what's important in reimagining our economy.